We saw pressure on FedEx stock today after the company produced a 2024 profit outlook that lagged analyst expectations. Package demand is weak. Despite lower forecasts from every sector except technology, our guest says there are still lots of investing opportunities. We're joined by James Callahan, Associate Portfolio Manager at Barometer Capital Management. Just take a look at FedEx, though. Did anything jump out for you with these numbers?
I guess what jumped out for me, and we've not been involved in the stock in some time, is that when a company is going through a cost-cutting program like FedEx is, you need to see that come through in EPS guidance. Obviously, it didn't for 2024. So I think it makes sense that stock was under pressure overnight. I think it's actually reacted quite positively this morning versus where it had been trading after the report. But no, we need to see some evidence come through on the bottom line of the cost-cutting program on FedEx.
And they have been cutting back a lot, firing people? Or,
So just rationalizing across all segments. Another negative aspect was the departure of the CFO. You know, that's never perceived positively when you don't have an immediate replacement. So some negative aspects there. We're not involved and we'll remain on the sidelines.
What's your broad strategy when it comes to tech?
To tech, I mean, it's been a great place. Through our process, a lot of the large cap US tech names have been investable for most of the year. We've had big allocations there and they've returned quite nicely for us. So, you know, we like the AI theme, we've been involved there, but it's been nice to see over the last month or so, the market start to broaden out and some interesting investment opportunities have come out. For example, when you look at the housing starts number in the US yesterday, we think that that's a bullish read-through into the home building sector. So what that number means, housing starts in the US, we saw yesterday they reported during the month of May, construction began on 1.6 million new single-family homes or apartment units. That's against expectations for 1.4, and it's actually the biggest month-over-month increase since January of 1990.
Is that because houses are so expensive in many markets? There's demand for new homes.
There's been robust demand for new homes, I think more than most investors would expect, given how low housing affordability is right now. So it's created this interesting confluence of events for the home building names specifically, whereby housing affordability is quite low. Mortgage rates are up substantially. If you look over the last 2.5 years in the US, the 30-year mortgage rate's gone from sub 3 in some cases to about 7% right now. That's creating pressure on existing home inventory. Nobody wants to sell their house, move to another one. What we've seen is the home builders capitalize on this by offering rate buy-down programs. So if you go and buy a new construction in the US, a lot of the time the construction company they'll pay upfront to buy down your rate. Rather than 7%, you can get around 6%, sometimes sub 6%. Because they want to take share in the housing market now and capitalize on their advantage. So
they'll help reduce the cost of your loan.
That's right. And get new home buyers into the payment that they can afford and that they'd like.
D.R. Horton would be one name you favor in this home building space.
Absolutely. It's the largest U.S. home builder by volume. It's been a name that we've been involved in for some time now. From a geographic perspective, we like their footprint. So they operate on the coast. They operate in the Sun Belt. All beneficiaries of migration trends in the U.S. right now.
Yes.
There's a lot to like. They have a great capital return program. They buy back about 2% of shares outstanding every year. They pay about a 1% dividend. They focus in the right segment of the market. So their median home price that they sell is about $375,000, so close to the low end
for
first-time home buyers. It is. They focus on the entry level.
Right, yeah. That's so weird, isn't it? $375,000 is cheap for a home these days.
I know, it doesn't seem like that in Toronto.
Yeah. What about the other players like Lennar? Are you generally positive on the sector?
I think that a lot of the tailwinds that I've explained do persist across the whole sector. We've chosen our footprint, geographically, we've been a bit selective. So, D.R. Horton is our largest exposure there. We also like Century Communities, which is like a smaller version of D.R. Horton. They're a bit more junior, I think about $2 billion market cap. They operate in the same geographies and they serve the same segment of the market. So it's tough to go wrong in that sense.
One stock you do follow is La-Z-Boy. The share's up about 18% this year. Are you a holder of La-Z-Boy?
No, we're not. It is up. I think they had a big January. And besides that, they've been under pressure for the rest of the year. I know I did look at their earnings report they released last night. And despite beating analyst expectations on the bottom line, revenue is still down 18% year over year, so that stock is still challenged. It's not one that we're currently involved with. It doesn't screen well through our process.
I guess it's discretionary. You don't really need a fancy chair.
Exactly. It's a discretionary, yeah. I'm sure they still experience some supply chain difficulties and the like.
Just to get back to tech, have some of the big tech names, have you ridden them right through? Did you hold them in late 2021? They went down and you stuck with them?
No, our process is pretty technically based. So while we owned a lot of these names through 2020 and through much of 2021, we got stopped out late 2021 from a lot of the large cap US tech, thankfully. Much of the year last year, we actually had no tech exposure across all of our products. We got involved at the beginning of this year when we started to see some positive divergences. Economic data started to improve a little bit. We started to see CPI come down month over month in the US. And then the benefits of generative AI, it can't be overstated. I'm sure many guests talk about that. So we like that as well.
Let's have a quick look maybe at a 5-year chart for the NASDAQ 100 as a proxy for tech. So do you have a specific rule? Do shares have to come down? If they come down a fixed amount, you're out of there?
That's part of the process. I would say that's the biggest weight in our selling process. We would look at a confluence of factors, including price action.
And here is the 5. Wow, NASDAQ 100 is getting back up there, isn't it?
Yeah. Absolutely. I mean, it's been difficult as an active manager when you look at the largest 10 US stocks have contributed to the majority of positive return in the index year to date. But we actually think it sets up a positive environment for active management because there could be a performance chase into year end. It's tough to be ahead of the benchmark right now.
That's interesting. So how does that work? I've heard of this in the past, that portfolio managers obviously try to dress up their year-end numbers. I know we're a long way away from that. We're only at the solstice today. But what happens with that? People jump on the top performers of the year?
I think so. And I think it's happening in 2 ways now. So I think we're seeing some incremental buying in mega cap US tech as investors get forced in. So in the largest names, in Apple, Microsoft, NVIDIA, which have been up the most year to date. But I also think we see it as the market broadens. We see just money flowing into US equities specifically. If you look at the Bank of America Fund Managers Survey, investors relative to history are substantially overweight bonds and defensive equity allocations and substantially underweight tech and economically sensitive equity allocations. So that could revert over time as the year progresses, and we think it benefits the equity markets.
And are there any Canadian tech names that you favor right now?
Not really. In investing in Canada, we've been focusing in the materials space and actually in the industrial space as well. So it definitely could happen that some of the Canadian tech companies can catch a bid. And Shopify being the biggest, the outlook for that could be quite good. But we've been focusing elsewhere in Canada because the opportunities in the US tech are so good right now.